Beware, the stock market is overvalued. Hello, I'm Steve Forbes, and this is What's Ahead, where you get the insights you need to better navigate these turbulent times. There are noteworthy signs that the stock market is overvalued. Most striking is the overall value of equities vis-a-vis our GDP. Stocks are now worth about 180% of GDP, a level not seen since 2000. After stock indexes reached a high early that year, they fell into a bone-crunching bear market. Other factors signaling caution are recent initial public offerings, IPOs, which have gone up, some of them 80% or more from their initial offering prices. This kind of frothiness is traditionally not healthy. Along the same lines, there's been the eye-popping boom in SPACs, special purpose acquisition companies. A SPAC has nothing inside it except the promise that it'll soon buy a company. It's a way for a corporation to go public without the laborious route of a traditional IPO. Stock market optimists, though, point to two bullish factors. One is an enormous amount of cash still available to invest. The other is that by spring, thanks to COVID-19 vaccines, the nightmare of lockdowns will be over and a pent-up economy will result in a powerful comeback. But there are two important bearish factors that could well mitigate these positives. One is the wave of anti-economic growth regulations that will likely be coming from the new Biden presidency. These will adversely impact energy, communications, high-tech companies, financial institutions, agriculture, and many other sectors of the economy. The extra cost these new rules will particularly hurt new and small businesses. It is true that such adverse actions will meet a flurry of lawsuits, but they may only delay implementation, and the uncertainty of the outcomes will hinder positive capital expenditures by businesses. The second bearish factor is the Federal Reserve will likely print too much money to pay those multi-trillion-dollar pandemic relief measures. The result over time will be an unexpected inflation. It is a fool's game to try to precisely time when a bull market ends. What then should an individual investor do? Three things. First, continue to make scheduled payments to your retirement funds. Don't sell stocks in your 401ks and IRAs. Stocks always come back from bear markets. Your retirement funds, remember, are for the long term. Second, for your other holdings, keep a healthy cash reserve. If you don't have cash, pare down some of your existing investments. Don't buy new holdings unless you feel they are truly special situations. Finally, buy some gold, either the yellow metal itself or a sound gold ETF. Think of this as inflation insurance. I'm Steve Forbes. Thank you for listening. Do send in your comments and suggestions, and I look forward to being with you soon again.